In this video, I want to talk about why you should only trade credit spreads on ETFs. Now again, can you trade them on stocks? Absolutely, I'll talk about the cases for that. But in this video, I want to walk you through the key reasons why you should only be trading on ETFs. So let's dive right into it because I don't want to waste your time. Okay, here we go. What are we doing with credit spreads? Well, with credit spreads, we're just making a bet that a stock will stay above or below a certain level. So for instance, if we're trading put credit spreads, we're simply making a bet that the stock, which is this, will stay above a certain level. For calls, it's the same thing, but for the inverse, we're making a bet that the stock will stay below a certain level. So as long as, for instance, for a put, the stock stays above this level, we make money. Now, what are the cases that would make us lose money? Well, when a stock, is very volatile, then anything can happen. So we're seeing here, like, let's say a stock is moving right here like normal. What affects a stock? Well, there are a lot of things that can affect a stock. Let's say news. Let's say weather. Let's say economic reports, financial reports, financial statements, the CEO doing something, supply chain issues, anything like that can affect this stock. And with effects like that, let's say it's a bank that heavily relies on interest rates. We have an interest rate change that's not favorable for banks. Okay, things like that are going to cause the market to drop and have a sharp decline. Not only the market, but the stocks that are specifically affected in general. So we can see here that the overall S&P 500 market can just consistently be trending up like this, and it'd be nice and safe. But then we have Apple that's being tracked, or Tesla, which is like doing like this. We don't know what's going on. Why is this hard to do for individual stocks? Well, if you're trying to simply trade set it and forget it credit spreads on individual stocks, you're going to have random news that goes and makes the stock go below your level. Versus ETFs, which does still go up and down, but it's a slower, more averaged approach. Why? Because let's say the S&P 500 index, for example, S&P 500 tracks roughly the top 505 stocks. So now we do have these stocks that have terrible days, but we also have stocks that have good days, and it all averages out, so we don't have any sharp declines, which means that when we're trading ETFs, we have a higher win rate because of how diversified these assets are by default. That is the first reason. Diversification slows down the stock and allows it a better chance of it staying above our strike price level. Number two, ETFs, specifically the ones that we trade, QQQ, IWM, SPY, stuff like that, are very, very liquid, which means that they have great spreads for spreads between the bid and the ask price, and it's really easy to get in and out, especially with larger size. So this is why it's great to trade credit spreads on ETFs, because it's super easy to get in and out, and that's a big issue on individual stocks, especially as you start to get away from the FANG stocks or very popular stocks. So guys, for these two reasons alone, for win rate and for entry and exit purposes, you should only be trading ETFs. Now, this in my recommendation applies to set it and forget it strategies, where you're someone who works full-time, someone who's a busy parent, something like that, where you don't want to spend 24/7 on the screen. You just want to come in at the end of the day, place a trade, and let it expire worthless in the next 2 to 3 weeks and make money. If that's what you're trying to do, ETFs are perfect for you. That's why I use them in my program, and all my members use them. However, on individual stocks, you have to do more technical analysis and more of an idea of which way it's going and catching that move, because if you don't catch the move, then you're going to do it wrong and you lose money. So again, those are your difference between ETFs and stocks. You have to be more specific on stocks, and you can be more laid back on ETFs. Anyways, guys, this is why you should only trade credit spreads on ETFs. If you want to learn about my favorite ETFs to trade and why, I'll be doing another video on that, so please smash that subscribe button. Alright guys, I will see you in the next video.